We are live. Welcome to the Rebel Dividends Investor Update. Today is Tuesday, August 22nd. All the data on today's updates based on yesterday's. Couple slides before we jump into the same content held in the email. There is a suspicious new Bitcoin address that has accumulated over $3 billion worth of Bitcoin in the last 3 months. It's unknown who it is. Speculation, maybe it's BlackRock getting ready for their ETF. But it's not really clear. So we're in a situation in the next several months that we think will be very bullish for markets so long as inflation continues to fall and the economy doesn't slow down too much, which is what it appears we're actually at the risk of the economy running too hot versus too cold. So our primary concern is trying to predict what's going to happen in the next 3 CPI reports and labor data prints. So here's some big macro data that we believe is going to drive the inflation down. This is looking at the savings. The excess savings from the pandemic is finally starting to wear off. Now people have had big increases in their wages, so there's still plenty of money out there, and income. So we're not seeing the economy falling off the rails, but we do think the excessive savings, which was driving a lot of inflation, is about to slow down rapidly. And with the US jacking up interest rates and having the reserve currency, we're seeing the effects of the rate hikes from the US affect Europe and Asia much earlier than we're seeing it hit the US market. So we can see in Germany, the producer price index has shot -6. We believe their inflation rate is about to drop precipitously. If we look at the same chart, but of all of Europe, it's around -8% on PPI. And we believe their CPI is about to fall from about 5 towards the 2% target quite rapidly. And then over in China, as we looked at last week, their CPI is at 0 and their producer price index is already negative. And they're actually allowing their real estate market to collapse because that has been essentially a big waste of money that they've been doing for several decades to keep their GDP growth up and try to provide jobs to too many people. Now, one of the main reasons we believe the stock market and thus the cryptocurrency market will stay strong is due to the government stimulating the economy with massive spending. So we're at $5.7 trillion in spending this year. We're only on the 3rd quarter. So we're likely going to break into that mid to high $6 trillion level. So the US government is spending massive amounts of money. This is what's been causing pain in the bond market with the high inflation. But if they can get away with running high deficits and still have falling inflation, that's going to be what we believe is going to be the main catalyst beyond the Bitcoin halving cycle and the election cycle, as well as interest rates falling to get us into the next bull market. China is facing a Lehman moment that could spark a financial crisis, according to the Wall Street Journal. The Chinese economy is flattening, youth unemployment is skyrocketing, and $5 trillion in homebuilder debt is at risk. Now the government is ordering banks to prop up the yuan and stop selling stocks and bank assets to prop up failing markets, while government statistics go dark one by one. And so their currency is at a level that if it goes much more devalued, it's typically led to sell-offs in US markets. And that's because the Chinese freak out, they dump their treasuries, which make interest rates go up, which makes the value of the dollar go up, which puts further pressure on their own currency, but then they're selling their dollars to prop up their own currency. And so it's a short-term fix, but it's creating more and more stress on their own currency. And the reality is there's no way for China to fix this problem. The US really has to ease guidance in terms of interest rates and quantitative tightening. And the only way the US is going to do that is, again, if the inflation continues to fall. So that's really where we're at with markets. Share price dropped this week. We had a flash crash, which we'll talk about quite a bit today. And we're at 0.00677. We issued a 0.0002 per share dividend, which is 2.95%. Our share price fell 16% week over week, compared to Ethereum's 9%. Now we were 170% leverage. So the reality is that should have been more like a 26% drop, and we only had a 16% drop. And that's because our hedge performed very well, and we almost nailed the bottom of the crash, which was wild. We'll talk about that when we get deeper into the update. Outstanding shares is at 514.9 million shares. Portfolio value is at 3.4 million. We are currently long 3,802 Ethereum, which is a lot less, but I want to note the reality is we still have a similar position as last week. We reduced losses by about 34% compared to what they should have been, and we reduced the debt by 4.4 million. So we lost about $4 million worth of Ethereum, but we paid down 4.4 million in Ethereum. And we can re-leverage back up to that level quickly, but I do want to see the bond market start to bid before we go more aggressive at Aave. So with the current level of our loan health at 1.2, we'd have to see Ethereum hitting something like 1,300 to have any more pain off. So we're using alternative options to get that leverage in the portfolio. That's not going to put us at such a difficult situation in Aave. So we'll cover that as we dive into some of the new positions we built out. So again, we dropped the value of the Ethereum position, but we also dropped the loan. So net, we didn't really change our positioning dramatically. We've slightly reduced the leverage, but we've replaced that leverage in different ways that won't be so hard to manage. And again, we'll cover how we've done that in this presentation. Currently, we have a pretty small hedge compared to last week. We'd really loaded the boat last week when we were seeing the bonds continue to have volatility. And we actually got quite lucky going very short Ethereum right before that flash crash occurred and removing our leveraged altcoin position. And again, we did this just because the bond market was having so much trouble. So currently we have a $122,000 short with 15 times leverage. We don't need as large of a short now because our loan health has gone up dramatically from last week. So last week we were running about 1.08, which gave us around a 10% volatility swing before we had issues at Aave, which forced us to have a much bigger hedge. Now that we've increased the loan health, we can basically handle a 20% swing, and we've already just had a pretty significant pullback. So we're running a little bit lighter hedge this week. Loan health is at 1.2. Current leverage is at 107%, but I would say this is very similar positioning to last week, but with less risk at Aave having to deal with volatility swings. And that's because we've reallocated quite a bit of capital to smaller market cap cryptocurrencies, which again, we'll cover in a minute. Dividend this year's at a penny and 3/4 cents. Ethereum's return year to date is 37%. Ours is at 42. Again, in the start of the year, the extreme volatility events, primarily due to the banks getting shut down that held Circle's $3 billion in capital, created a big flash crash that we were not prepared for at the time. Then we had the SEC file against Coinbase and Binance, which created a pretty significant swing. That again, we were not quite prepared for at the time. Now we are. Dividends. So again, our goal now is to close out the year with at least 2 to 3 times return of Ethereum moving forward. And we believe we have the tools in place to be able to handle these crazy volatility swings that this market continues to have. And then again, to be very leveraged when we get into the melt up. So we can have extreme volatility to the downside, which is what we've been dealing with primarily for the last year and a half. But once we do get into a bull market, you can look at these charts and these assets just scream straight up with panic bids to the upside. So we want to have that leverage when that time comes so that we can get that share price up and then increase the dividends back up. Dividends last year is at $2.25 million, and dividends this year has already breached 3.2 million. Portfolio update this week, our portfolio had a drawdown of 16%, while Ethereum had a drawdown of 9%. Our hedging strategy performed very well, reducing losses by over 34%. On Thursday, the market gapped lower by 14% in mere minutes. So what happens is a lot of people have leverage, and at certain prices, the loaning systems will auto liquidate. And so a lot of people got liquidated in about a single candlestick. It was one of the quickest drops we've seen in a while. Hundreds of millions, I think it was like $600 million was wiped out that day. That was leveraged. And luckily we were heavily hedged to protect us in that sell-off. We had removed our altcoin long position, which was 5 times long at the time. And we put it into a 20 times leveraged short position on Ethereum. And then we were supposed to pull the hedge off at something like 1700, and it dropped within minutes down to 1550. And by the time we saw it bouncing, we started selling all of our short positions from 1575 to about 1625, cashed it all out, bought the dip, and did quite well with that event. So we made this adjustment because the bond market continues to have downside volatility, which makes us nervous of greater risks for volatility in long duration assets like tech stocks and cryptocurrencies. During the crash, our short position had realized profits of $552,000. And we actually won a prize at the Gains Network of $8,900 because we were the most profitable account in the past week. I think we've been the most profitable account at the Gains Network since we've been using it, and that's because we use it to hedge our portfolio. Unfortunately, we were forced to liquidate a portion of our portfolio at Aave when the loan health reached 1.0 during the flash crash. Aave paid down $4 million of debt with 2,269 Ethereum, which brought our loan health back up to 1.26 as of Monday morning. We brought the loan health back down to 1.2 by borrowing more capital and putting it back to work yesterday. We were able to buy back 291 ETH with the $535,000 by exiting our yield farm position and closing out our hedge, which was also used to rebuild a $120,000 new short position and a $100,000. We went from 5 to 10 times leverage now in altcoin long positions. And as of yesterday, I had gained $20,000 over the weekend, bringing its value to $120,000. We're now long the following mid-cap altcoins with 10 times leverage. So we're really essentially basking the asset classes into three main buckets right now. We have the main one, Ethereum, which we host at Aave and leverage using debt. And as the value of that Ethereum goes up, that gives us more ability to borrow and put more capital to work. Then there's a group of mid-cap altcoins that are able to do straight leverage, which we currently have 10 times leverage in SHIB, Pepe, GMX, STX, APT, Comp, Aave, Curve, and Rune. So again, 10 times leverage. So even though it's $100,000, it's essentially $1 million position. And this auto leverages as the market goes up. So essentially a 10% jump in any of these will double the value of this position. Our short positions are spread out across as many cryptocurrencies as possible, including Algo, Ape, Arbor, BNB, CHZ, Curve, Dash, EOS, and we're using 15 times leverage on these. We have EOS, GRT, Mana, NEAR, SNX, Tron, XLM, XRP. And then we also have Makers, Sui, SHIB, CFX, Render, STX, Sol, Inge, and Rune. So in total, we have 23 short positions, leverage times 15 currently. Today, we took the loan health back down to 1.2 by borrowing $180,000, and we used this capital to rebuild a $100,000 yield farm and an $80,000 microcap portfolio. So with the big sell-off last week, we've seen some incredible opportunities to, again, go leverage long the mid caps and then to pick up a handful of microcaps. The microcap portfolio are tokens we believe are at very attractive price levels with the potential to increase in value by 10 times by the time Ethereum reaches its recent high which is about 2.7 times gain from current levels. And again, if Ethereum breaks into new highs, these microcap coins could greatly outperform the 10-time. So here's what we're looking at. Rune is ThorChain's main feature. It's the ability to facilitate decentralized and permissionless exchanges between assets on different blockchains. So the high for this coin was 21.32, and we're getting in, we got in yesterday or today at $1.43. If this goes back to its high, it's a 1,390% return. And again, if we break the whole market into new highs, the new highs could be considerable. Here's a look at these charts. So again, you can see when they melt up, they really do melt up. Arweave is a decentralized storage network that seeks to offer a platform for indefinite storage of data. The high for this was at 91.27, and we got in at 425 to get back to its recent high. It's a 20-time return from here, or 2,042%. And again, you can see it can be long and boring and painful, and then when the market goes wild, they melt up. And so if you look at the price action from August to December of 2021, again, that's what we're trying to position you guys for, to really get that share price back up. AXL, and again, this is only $80,000 position. It's tiny compared to the 6 million we're long Ethereum. So we're just diversifying the portfolio and trying to get the ability to get 3 to 5 times return of Ethereum without having to put so much pressure on our Aave position, essentially. This entry point is at 35 cents. At the high was $1.14, 225% return to get back to its recent high. This one's much more new. And again, we think it could go far higher than that. Gel, the Gelato network, is Web3's leading automation network, enabling developers to automate and relay arbitrary smart contract executions on and across all EVM-based compatible blockchains, such as Ethereum. This at the high was 438, and we had an entry of 0.24. So what we did to build this list was look at where all the big venture capital firms have a lot of money, and then Solve, who's very good at analyzing this one, killed all the dead projects. And so we really left with were 8 or 7 projects that we think are strong and have a really bright future ahead. And you can see that chart here. Giddy mission is to democratize access to DeFi for all. DeFi in its current state is inaccessible to most people due to the complexities and risks with current set of tools and practices. And so they're going to try to make this easier. This is trading at 0.009. Its high was 35%. So we're looking at a 3,788% return just to get back to its high. And this one perhaps has the highest potential return if it gets back to its recent high. Jasmy Coin is a cryptocurrency project of a Tokyo-based Internet of Things provider. As a system, the Internet of Things includes mechanical and digital elements endowed with an identifier and the ability to transmit data. To get back to its recent high, it's looking at a 142,000% return, which is astronomical. So these are the 7 microcap positions we picked up, including Metis, an Ethereum layer 2 scaling solution, aiming to solve the blockchain trilemma. The blockchains cannot be decentralized, secure, and scale simultaneously. It also strives to solve Ethereum's biggest challenges: speed, cost, and scalability. The recent high was 173. We got in at 1239. So we'd be looking at a 12 times return to get a 1,300% gain to its recent high. This week's dividends and total fees for management was 128,000 with an 80-20 split and a 2% fee on new shares sold. We're going to expect the same dividend until Ethereum prices are back in the 1,900 to 2,000 range. So we were close to that a week and a half ago, and then we've had this sell-off here. But as you know, when Bitcoin and Ethereum do go up, they can go up very, very rapidly. So we could be back to that price level sooner than investors think. We're just going to play it relatively safe until that TLT starting to bid back. So it's in the 92 to 93 level. TLT relates to the 20-year treasury. I would really like to see it back in an uptrend. It started off the year well, then the inflation looked stickier than people thought. The bond market sold back off, and now we've just been issuing a massive amount of debt. And these high interest rates are causing Japan and China to have to dump their treasuries to protect their currencies. So the second the tides change in the bond market, I do think we're going to see bonds get a massive bid, and as interest rates fall, the valuations of stocks will become far more attractive. So we just need to be patient. I thought we'd see the bonds bidding by now with 2 consecutive inflation beats. But the simple fact is that we have just too much supply. So I don't think the bond market's worried about the inflation as much currently, but rather there's just so much being issued currently that there's just continued supply problems for now. Now, the good news is because of the debt ceiling, we had to basically not raise money all summer. Once they lifted the debt ceiling, Janet Yellen's just been raising money as fast as possible. But that's going to slow down dramatically in the coming months. And then they're planning a bond buyback program next year. So as long as those interest rates start to fall here, we could have Japan and China stop selling their treasuries, and we could see a big bid. There's also a massive short position in the US bond market. If that was short squeezed, that could also cause interest rates to fall rapidly. And again, we're seeing Europe and China's inflation fall dramatically. So we do think the US is going to follow the same trend. Macro commentary, the next major economic data to focus on will be the August CPI released September 13th, the non-farm payroll September 8th. This week on Friday, Jerome Powell will be speaking at the Jackson Hole event and will likely give hints as to if and when they may pause raising interest rates. Currently, we have 11% chance for a rate hike in September and a 43% chance for November. And we really want to see the odds of that November rate hike go to 10 or lower to believe that we're absolutely at a pivot. And again, currently there's an 11% chance of rate hike coming at the September FOMC policy rate decision meeting, September 20th. Assuming inflation is falling and labor data is cooling off, we would expect to see no more rate hikes and an official pause before the end of the year. Probably going to need 2 more, if not 3 more falling CPI prints and cooling labor data for the bond market to really price that in. And again, so what happens when the Fed pauses? Stock markets rally aggressively. The only exception was in 2000, and that's because we had a double whammy of inflation. And then they tried to balance the budget. They actually ran an account surplus, and you got a 2-year bear market with a big head fake. Assuming these politicians don't want to balance the budget, which I guarantee you they do not, so long as inflation's falling, we should expect interest rates to fall and to be very close to the Fed pause and have a pretty good runway for markets. Micro commentary, we did have an unfavorable ruling against Tornado Cash. We possibly had some pain in markets relative to Chinese real estate debt collapsing. But in general, it's not really clear what the exact catalyst was for the sell-off last week. Definitely the bond market's causing issues. We know China's allowing their real estate markets to deflate. The Tornado Cash ruling was conflicting with the Ripple case. The SEC is trying to appeal the ruling that was favorable to Ripple. But as far as we know, it could just be BlackRock intentionally creating volatility to build their position prior to a spot Bitcoin ETF. So there was no real specific news related to that specific sell-off on Thursday, which was quite violent. And it got bid back really quickly after the sell-off occurred. So it does seem as though there potentially was some market manipulation by design. First week of September is when we may get more news back from the SEC on decisions related to the last spot Bitcoin ETF filings. Today we had the Grayscale Trust come back with some news saying there's no decision coming on that court case related to they're suing the SEC about not being able to convert the trust into an ETF. So maybe some news in September, but there is rumors that the SEC is just going to try to push everything to 2024. Okay, very good. We'll take questions now, and I'll put up Dean's screen. Joe, yeah, just give Dean a call and let him know what you need to do on that one, okay? I'm so sorry to hear about your family in Maui. Okay, Don says, do any of these microcap charts look like any other altcoins that have? So yeah, so primarily what we don't want to do is buy microcap projects that, they got they raised a ton of money and then they did a horrible job and they didn't create a product. So like EOS, for example, raised $3 billion and then built a bunch of crap. So that's one of our favorite tokens to short. So we're primarily looking at projects that we believe are still just getting their feet wet and just had, they raised money in the bull market, and then the inflation and the bonds just crushed everything. And so they've been building, but it's not yet determined whether they're going to be successful or not. So we're not looking for old projects that are just dead and on the balance sheets of these VCs. Really looking for exciting new technologies that are still being built or are in the early stages. Bill's saying, how are you defining this cycle? So I would expect that as we reach the Bitcoin halving and the election, we're going to have a melt up, absolute melt up into next year, and maybe even into two. Typically, you want to sell into the election. And so, yeah, I would actually expect we're going to have some sort of melt up into 2024 and probably want to deleverage by November. Maybe the inflation in the bond cycle could be a lot longer, and it could drive markets up for a longer period than 2024. But basically, we're going to be looking at interest rates reaching a certain level that's low, the dollar reaching a certain level that's low, and Bitcoin reaching a new high. And whenever those all top out and then crash would be, basically when we'd have said that was the cycle. And of course, you never know that until hindsight. I think Ethereum can hit anywhere from $10,000 to $20,000 this cycle, and that it could be happening next year, especially if the Bitcoin ETF, spot Bitcoin ETF, is approved for BlackRock, because these guys have massive sales teams. All these big banks have huge 10,000 plus staff to sit there and call every rich person around the world and pitch their product to them. So this market could grow from $1 trillion to 3, 5, 10 trillion in a very short period of time when you get the world's largest financial institutions with massive sales teams and the legal structure to legally go push it into stock accounts. And if Bitcoin explodes its market cap, that money gets reallocated into the smaller markets, and then those are the ones that can outperform. So yeah, we really have every possible thing set up for us the second the bond market is cooling off here. People want to know what the price of our shares will be if we hit $20,000 ETH. Well, it depends on how much leverage we have through the whole process, how ballsy we want to be to the top, and what size of a dividend we want to deliver. Our goal is to at least outperform Ethereum by 2 to 3 times minimum. And it's been a struggle to do that initially. To start off the year, if you recall, we were more than outperforming it by 2 times. And then we had the Silicon Valley Bank get smashed by Elizabeth Warren, which probably illegal, but was done on purpose, caused that massive flash crash, and we were over leveraged and under hedged, so it cut out a lot of our overperformance. And then we had the SEC case against Coinbase all of a sudden, caused some more volatility, naming a bunch of these altcoins as securities. So we were prepared for that one, luckily. And so the last few flash crashes, we've done a very good job at essentially not letting the leverage dramatically hurt our performance long term. So I'd have to calculate that, but we would like a minimum of 2 to 3 times the return of Ethereum. Oh, Greg is Solve's friend. Yes, Solve's right here, clicking away on his quadruple monitor, Greg. Yeah, I was in the kitchen and he comes running in. Ethereum hit 1550. We run back in the office and it's like, wait till it bottoms. And it looked like it was bottom. I was like, sell it all. So it was a wild Thursday, but we really have the talent and tools and systems in place now to do a much better job with these extreme volatility events. And we're getting more creative about how to get that return to the upside without having to put so much reliance on leverage at Aave, which again is the whole point of these 10 times altcoin positions, plus the microcap positions, which are not leveraged. And we're getting our yield farm back in place. We really just want to be an expert at yield farming and slowly grow that as the market melts up so that we can deleverage towards the top and keep the dividends rolling. Don's asking, why is Bitcoin better than cash? So the main reason why Bitcoin is better than cash is, and well, it goes to this. There's a limited supply of Bitcoin that will never change. And then there's an infinite amount of money the US government's going to print. So that's basically the pitch, is that, you know, the value of the dollar has gone from about $1 to a penny over the last century in relative terms. And so, yeah, so look, we're, you know, the trend for the government is once they hit a certain level of spending, the whole financial system relies on that continuing. If the government doesn't keep running a $6 trillion spending spree, the earnings of the stock market are going to collapse and you're going to have massive layoffs. You're going to go into a depression. So what we're going to see is either the US or the whole world go through a Great Depression, or they're going to allow higher levels of inflation. Now, luckily, technology and demographics have been smashing inflation down in general. But as you can see, this is the trend of the government is very, very, very rarely do they reduce the annual budget. So we're now going to likely run $6 trillion of government spending, with about $3 trillion of that being debt indefinitely and growing at around an 8 to 12% rate. So I think it's about 6 years with a 12% rate of increase to double. So in 5 to 10 years, we're going to be looking at $10 to $12 trillion of spending and probably around 5 trillion to 6 trillion of debt. And so governments, when forced to make a decision, they either print money, which we call quantitative easing, to keep interest rates lower, or again, you let everything crash. So until we think we've got a government in place that wants to cut the military budget, cut Social Security, cut Medicaid, cut food stamps, and not get hung out to dry by all the powers that be and the voting populace, this is the trend, and this is why Bitcoin has had the single greatest return of any asset ever in the least amount of time, and will likely continue that trend. We're so early in this space, and now we're seeing in the writings on the wall. Why would the biggest financial manager in the world be launching a Bitcoin ETF if they thought the industry was about to disappear? Bitcoin is the first asset in human history with an absolute fixed supply and stock to flow ratio. It's deflationary, and we know exactly how much will be issued forever. Cash is the opposite. And that's from Solve, who's sitting here next to me and cranking away on the yield farm right now. Okay. Okay, Bill's asking, what's the effect of the shares? So yeah, so let's say an investor comes in with $1 million, and let's say the share price was $1. We're going to issue 1 million shares, but then we're going to add $1 million to the balance sheet. So it has absolutely no effect on share price. Same thing if you sell. So let's say Bill wants to sell his $1 million position. Well, now there's 1 million less shares, but we're going to reduce the balance sheet by 1 million. So the math doesn't change at all. If we were if we had so much money coming in that we we're going to actually essentially inflate the price of Ethereum just from our buying, then that's when it maybe would become an issue. But again, Ethereum's I think it's like $200 billion market cap right now. So we're anywhere near having any type of price impact on Ethereum. Some of these micro cap coins have very low trading volume. So if we were only investing in something like that, we'd have to be much more careful with how much capital we accepted. But again, we're essentially almost completely long Ethereum, the second largest market cap cryptocurrency. So hopefully the agony of waiting for our melt up is nearing, and we'll just be focusing on managing the volatility of a melt up. Leverage can be tricky. Even in a melt up, you can have these huge jumps, but then you might have a 20% retracement. So we got to be careful with the level of leverage and how we go about trying to play the melt up when it finally gets here. And then be careful about deleveraging once we hit new highs. And then from there, the opposite strategy, which we should have ran last year, which would be to essentially short coins and then yield farm like Tether versus USD, simple things like that to still maintain profits and dividends even through a bear market. So unfortunately, I got the timing wrong, obviously last year. But I don't want us to miss out on the next bull market. So we're staying strong, leveraged, and positioned to make a lot of money here. Bill says, do reinvestments have the same application? Yep, it's exactly the same. So it's basically like your dividend, you're giving it back to us to buy shares. So yeah, issuance of shares does not affect the share price in any way whatsoever. Okay, very good, guys. Well, if you have any other questions, give Dean a call at 505-322-7515. We've been working very hard to get this portfolio rocking for you. We also have the airdrops that we're qualifying for. So again, we're trying to get our feet wet with small positions in assets that can outperform Ethereum 10 to 100 times. But the cycle typically is Bitcoin goes up first and leads the market, then Ethereum jumps, and then it explodes all the small positions. So all the small positions, we want to essentially have the expertise and just have small positioning in currently. And then as we see Ethereum balloon higher, we'll be able to borrow from Aave and then dump that money into these small caps. So again, it's typically Bitcoin outperforms everything to lead. Then Ethereum will outperform Bitcoin dramatically. And then all the smaller market cap coins come in after that and melt up last. It's not always exactly how it plays out, which is why it does make sense to have some small positions in each of the strategies early, but that's what we'd expect. And the main reason why is just look at the money flow. So first, we're going to likely have the Bitcoin spot ETF get approved, which could potentially bring in hundreds of millions of dollars, but it's going to be stuck in Bitcoin in stock accounts. And these retail investors really won't be able to change anything about that. They're just stuck long Bitcoin. But all the people who hold the real Bitcoin can now go see these massive gains in Bitcoin and say, okay, well, what's going to go up the most next? So they'll sell their Bitcoin and then dump it into Ethereum or Polygon or something of that nature. And so that's why we have the majority of our assets long Ethereum. And now that we have this expanded staff and expertise, just dabbling our toes into the smaller positions that we think will, again, outperform Ethereum 10 to 100 times, but not initially. Okay, very good, guys. Well, thank you so much. We'll see you back next week, same place, same time. Expect the same dividend until we get at least to 1900 on Ethereum. which could happen quicker than you think. We were almost there a week and a half ago, and then we got that very odd sell-off on Thursday. So thank you guys so much. And again, we'll see you back next week.